In this video, we're going to wrap up our series on navigating actions after losing a job, specifically focus on managing your available resources and thinking about an order of utilization. What I mean by this is when you were working, you had that income coming in to meet your expenses. But when you're unemployed, you may not have that income coming in, but you still have the expenses. Therefore, you need to tap into existing and available resources to meet your expenses. So we're going to go through a hypothetical order of utilization based on this. Now, this is possible order based on general liquidity and tax characteristics, but this is not personal financial advice. Full disclosure, your order should be what's best for your individual financial situation. This is just more for general educational purposes based on liquidity, taxation, and interest rates, because you might not have access to all these resources. Okay, now that we got that out of the way, let's get into it. So when you're unemployed and need some cash to meet your expenses, most people think of tapping into first your cash on hand, right? Your checking and your savings accounts. And the reason why you would do that, because it's easy to access, it's completely liquid, and it's generally after tax dollars, right? You don't have to pay tax again on the cash that you have in your bank account generally. So that could be your first line of defense, is utilizing existing cash to cover your expenses. Once you've exhausted that, then the next area to think about would be potentially taxable investments. What I mean by taxable investments is a trust or brokerage account, right? Because the reason for this is it's completely liquid as well, right? You can access that at any age without penalty, and you pay tax on capital gains, right? So the difference between what you sell it at versus what you bought it at, and that's generally at a lower rate compared to other types of withdrawals from like retirement accounts, for example. So taxable investments could be the second area to look because it's liquid and you're paying tax at more preferential rates. The third could be like a home equity line of credit or a cash out refinance if applicable. A home equity line of credit, you can access funds from that tax-free, so you're getting that money tax-free. You are paying an interest rate for that cash, and it tends to be higher compared to other types of debt out there, but it is tax-free. And then with a cash out refinance, right, if it's applicable for your situation, you could also access that money tax-free. The next one would be Roth accounts, right? So in order to take qualified Roth distributions, you have to be over the age of 59 and a half and hold the account for 5 years. But you can take your basis or contributions in your Roth at any age tax-free. So that's something that would be available to you. And then for those that have life insurance, you could potentially take a life insurance loan on your cash value if you have a cash value life insurance policy, tax-free as well, as long as you don't exceed the cost basis in the policy. The next would be a rental property. Not a lot of people, have rental properties, but if you have one, that's also taxed at capital gain rates, which is less than ordinary income that you see with retirement accounts. Now, you might have depreciation, recapture, and other types of taxes to be aware of, but it could get you a large sum of cash if you need it to cover your expenses. Next on the list would be pre-tax retirement accounts. This has age stipulations, right? There's some exceptions out there for the 10% early withdrawal penalty, but generally, if you take money out of a pre-tax retirement account prior to age 59 and a half and you don't meet one of those exceptions, then you're going to pay ordinary income tax and a 10% early withdrawal penalty. So that may not be a good fit. The next one on the list would be personal property, right? So if you have excess vehicles and stuff like that that you may need to sell in order to come up with cash to meet your expenses, you could do that. From there, a personal loan, right? Personal loan could be another area to look at if need be. But the thing with personal loans is the interest rates tend to be higher than a HELOC or a mortgage. So you're going to pay more in terms of interest to get that capital. Credit cards would be next on the list. Credit cards have the highest interest rates of the debts, the 20% plus. So not a great vehicle to utilize, but in an emergency scenario, if you need the cash, that's there. And then the last, of course, would be primary residence. Of course, you'd never want to have to sell your home to meet your expenses or downsize. But if need be, and you have a home, you have that tool in your toolbox. So hopefully this was helpful just as a frame of reference based on liquidity and tax characteristics, again, for general educational purposes. And thanks, we'll talk with you soon.